Hey, everybody. Welcome back to the Beat the Odds of Business and Wealth podcast. I'm Trevor, and I'm here again with Josh Spurrell, who is in our Vancouver office. Hey, Josh, how's it going?
I'm doing pretty good, Trevor. Glad we could, get going again here. It's always actually like working out of the Vancouver office. So when you get me in the Manila office, I feel like I'm in a closet, but in the Vancouver office, I have a nice walk by the harbor in the morning, and then here we go. So
All right.
yes,
Let's giddy up
so
and get into it. So, what is our topic today? What are we talking about?
well, we are talking about the $11.7 trillion wealth transfer that is happening in Canada. And so we call it people have heard the largest transfer of wealth in history, right? And what that generally means when you start to dig into it, it's the boomers who have the wealth are transferring it. But the question is, what is the wealth and who are they transferring it to? And I think that's probably not well understood. Okay. And the first thing is just like understanding that amount is like it's $11.7 trillion. That's the estimated total household wealth in Canada, according to the parliamentary budget officer. So $11.7 trillion. It just sounds like a massive number, but people like drastically underestimate the number of rich people in Canada. We talk about it all the time that the top 20% own 73% of the assets, and it's bizarre to most people. And when you actually start talking about wealth and who has what, if you're not in that club and if you've never experienced that club, it's like it's very hard to understand, what that is. And that's important for our business owners because that's a big market to sell to. So $11.7 trillion. I'm going to break it down like what that actually entails. Okay. So there's approximately $2.8 trillion in life insurance and pensions. Okay. So
Wow.
$2.8 trillion in life insurance and pensions. And then we have a combined $2.7 trillion in the stock market. Okay. 1.5 of that is held within mutual funds, and 1.2 trillion of that is held directly, shareholders holding that directly. An astounding $1.6 trillion in currency and deposits. So that's whatever, that's cash in the bank, or whether that's a GIC, it's effectively cash or near cash. Okay. We have 700 billion, so 0.7 trillion of consumer durables. So all the vehicles and toys and boats, and it's not worth that much proportionally. Those things go down in value. And then the big hammer, $5.8 trillion in real estate.
Hmm.
5.8 trillion is in real estate. Okay. If you add that up, that's going to be more than 11.7 trillion. So where does the net worth come from? There's about $1.5 trillion in mortgage debt that's going to net off against that. And there's another about $700 billion in consumer debt that's going to net off against that. And if you total up all those numbers, that's going to give you a net worth of Canadians $11.7 trillion. So the first part is understanding the wealth transfer is like, what is the wealth? That is the wealth. Okay. And I don't know, Trevor, does anyone ever talk about that? Like, did you ever hear anyone talk?
No, I don't think anybody really talks about the $11.7 trillion that's available. I haven't heard any politicians bring it up. The only time that we hear anything like that would be when they're talking about the capital gains inclusion rate. That's about the only thing I'm guessing some of that is involved in. Now, what about you? Have you heard anybody really talk about this 11.7 trillion that's going to be transferred over to the next generation?
Yeah, like that. I mean, you hear people to it. You hear them call about the transfer of wealth, but I don't think people understand what the components are, right? And then you hit the nail on the head there, is you said they're transferring it to the next generation. But the big surprise is they're going to find out that they're likely transferring the majority of that to the government. The majority. Okay. And I'll break down like how that happens. Okay. So for the most part, what's going to happen is when you actually study the real rates of inflation and desirable assets, we have it, we can trace it, we can benchmark it against gold. There's an ounce of gold sitting on the desk right in front of Trevor there. You know, we always come back to that because it's the real measure of wealth. Being able to use it for 5,000 years, you know, beyond the 53-year or 54-year fiat currency experiment that we're now in. You start to realize what the real rate of inflation is, and then you start looking at the life insurance and the pensions. Okay, so let's start there. The life insurance and the pensions is the actual rate of return in these life insurance and pensions. I'm going to call it 4%, and you're going to have a whole bunch of life insurance salesmen who hate me. That's okay. I've been used to that for a decade now. That's fine. Please continue to sell your life insurance products because I own shares in all the life insurance companies. I just don't invest in those products. That's not my investment. So I need other people to buy it, just not my clients. Okay. My investment strategy depends on those life insurance dividends from those life insurance companies, but I'm not buying anything that they're selling. So, you know, I can sum up my insurance thoughts in one word, and the word is called term. But, you know, so we start looking at that is desirable assets are going up by 9%, and people have money locked in these life insurance policies and pensions, and they're maybe getting, I'm going to call it 4%. Maybe it's a 3 to 5% range would probably be more accurate, but I'm just going to hit it in the middle and call it 4%. So that means they are bleeding net worth at a rate of 5% per year. Okay, so 5% a year, they are bleeding net worth. And that means the desirable assets that you want to buy are going up by that. When you go to Disneyland, you wonder why the hamburger is $47. It's like the hamburger in Disneyland is going up by the real rate of inflation. The house in Cole Harbour, Vancouver is going up by the real rate of inflation. The house in Manhattan is going up by the real rate of inflation. The house in Miami Beach is going up by the real rate of inflation. But for the most part, the desirable, the other assets are not. You know, your house in Winnipeg is not going to go up by the same rate. You know, capital moves to the more desirable locations. So what that means is when you're actually, if you have an asset that's going up by 4% a year and desirable assets are, you know, going up by 9% a year, let's assume that holds, which is a very optimistic assumption because the rates of real inflation are actually speeding up. They're actually speeding up. And, you know, the assumption that, you know, we're going to maintain that delta is like that's a very optimistic. I don't think it's a realistic. I think it's a very optimistic assumption. What that means is every 15 years, those assets on a real basis, not on a nominal basis. On a nominal basis, it looks like you're making money, okay? But on a real basis, when you compare them to more desirable assets, you're basically getting cut in half every 14 years. So every 14 years, you're going to get cut in half. So, wow. You know, that's someone who's, you know, 65 years old. Let's say they live to the ripe old age of 90. They're going to get cut in half twice, okay? They're going to get cut in half twice is what's going to happen there. You know, we're going to call it 95, right? Like they're going to have a nice long life, but that's, you know, so if they have $1 million in this so-called pension or a life insurance plan, it's like on a real basis, it's like they're going to get cut in half twice. You're going to have about $250,000 purchasing power. Okay.
Yikes.
$250,000 in purchasing power. And you have to understand that when that's getting paid out to you, now you're also paying tax at, you know, kind of the, you know, when you're, especially on the pension, you're paying tax at, you know, as other income, which is basically, as we teach in the bootcamp, the worst category of income. Okay. Now, at least the life insurance policy is going to be preferable on a taxation benefit than the pension, but the rates of returns are going to be similar. Okay. And we see it all the time where people have pension buyout options. And while you're in the pension, it tends to be pretty good because you and your employer are contributing to this pension. And let's just say, you know, that pensions are different on the contribution rates and what people are paying, what the companies are paying. But let's just say it's you know, contributing half. So basically you're doubling your investment, you know, every time you make a contribution during. But once you're done your working years, now you're just getting the crappy rates of return inside of these pensions. And when we get the buyout options from these pensions, 99 times out of 100, when we look at the monthly rate if you stay in the pension, and we calculate it based on an average life expectancy. We could replicate that monthly after-tax cash flow with, call it a 4% rate of return. That's what's going to happen 99 times out of 100. So often there's an opportunity. People who are very astute know that if they retire just early enough before the pension vests, that they can get the cash out option and get it transferred into a lira and get control of it. And they get the best of both worlds, where the employer is contributing a whole pile of money while they're, during their working years. But then when they're not working, they don't have to live with that crappy rates of return. So I don't think people, truly understand that. And, what I said will upset a lot of people, because there's a huge industry of people whose livelihood depends on selling those life insurance products. So it makes me kind of public enemy number one. But I mean, that's just the truth, right? And I just tell people to think about it on a real basis. Like, do you think that insurer can get you a better rate of return on that insurance policy, you as the customer, than they can for me as the shareholder of that insurance company? It's like, it doesn't actually work that way. They're going to get a better rate of return for the shareholder. Okay.
Yeah. For sure. That's the whole reason for this podcast, is to let people know that there are other options out there. Now, for the longest time, like, most people don't know how to invest. They don't know what to do with their money. So, having an employer-based, type of pension plan is great for them. However, we've talked a lot in the past, both at the bootcamp and on this podcast, that, CPP is a Ponzi scheme and RSPs are a scam. Maybe, talk a little bit about that in this discussion, because, a lot of people are depending on their CPP, their RSPs, they're depending on their pensions. What can they do to A, I guess, protect it, and then B, can they transfer it over to the next generation without, the government confiscating most of it?
Yeah, I mean, I tell people RSPs are a scam, and I'll die on that hill that RSPs are a scam until the banks actually start changing their marketing material, because RSPs are a tax deferral tool, but they're not sold as a tax deferral tool. They're sold by all the banks as a fast way to grow their money. It's almost like they all wrote the exact same copy. If you start checking their websites, it's like it's sold as a fast way to grow money. And it's just not. If you want to grow money quickly, you do it with leverage, okay? And the opportunities to leverage with it inside of an RSP are very, very limited, okay? So, then you start to get into the mutual funds and the listed and unlisted shares, and that, kind of ties in with your RSP question, is those RSPs are generally destined, basically for a 50% tax rate when you die, okay? And a lot of people will try to finagle around that and say, well, you can transfer it to the spouse. Yeah, you can transfer it to the spouse. And then they'll start to finagle around. It's like, okay, but if you die early, you can transfer it to your kids. It's like, yeah, but like read the fine print. Your kid has to bring it into income by the time they turn 18. And so if they die when they're 17, they got to bring it into income over 2 years. They're going to pay 50% if you have anything sizable on that. And most people are going to outlive their kid's 18th birthday. So like, that's not going to happen. Basically, for the most part, if you have any substantial money inside of your RSPs, when the remaining spouse dies, you're headed for a 50% tax bill, but that's going to get confiscated. And in between those 1.5 and 1.2 trillion in both mutual funds and listed and unlisted, listed and unlisted securities, it's like most people are not getting a great rate of return. Some of those they're in bond funds. Some of those are in money market funds. A lot of them have outrageously high fees attached to them, especially the 1.5 million in mutual funds. And a lot of them are in historically underperforming stocks that we've seen it decade after decade. And so right there, it's like the likelihood that you're going to, if for the last 30 years, this sector of the TSX has not kept up with an ounce of gold. Like, what's the expectation that's going to happen in the next 30 years? Like, how many decades of proof do you need to see before you realize that that's not a likely outcome? And so most people get eviscerated on the rates of return inside of those mutual funds and the securities that they're holding. and most of those, a large percentage of those funds is being held in RSPs where it's destined for a 50% tax bill. So they're getting crushed by the inflationary pressures while they're holding the investments, and then they lose half on death. And that's, it's so-called, people think it's being transferred to the next generation. It's not. It's being transferred through inflation throughout your lifetime to the government, and then further transferred a large sum to the government upon death. And that's just the really hard, harsh reality on that. And that's the part that most people aren't expecting. So
Yeah, and like when it comes to these, let's go back to mutual funds and insurance companies. They are for-profit businesses. These people who are managing these funds, they want to make a profit for their shareholders. They got to make a profit for their bank. They got to make a profit for their insurance company. So where do you think that profit comes from? It comes from A, your contributions, and B, they invested in higher performing assets so that they win, and then they give you a pittance of the return. Not to mention, a lot of these funds are also invested in what? They're in bonds, right? In currency, which is seriously underperforming forever. Maybe talk a little bit about that aspect as well.
yeah, I mean, if you're investing in any sort of fixed income, and that's like, it's like the game, and it's like the default where people, they're pushed into this out of fear, and they're told that you should have, your age, that your percentage of your portfolio equal to your age in bonds. So if you're a 70-year-old, you're going to have 70% of your portfolio in bonds, even though decade after decade, it really shows that you're going to underperform stocks, you're going to underperform gold. And they're sold this because they're told that it's risky, but they do not understand the difference between risk and volatility. Okay, they're two different things, and they shouldn't be conflated. Okay, if you know something is not going to keep pace with the real rate of inflation over time, basically it's risky. It is a really risky asset to hold your money there for any long period of time. If it has 3 decades of performance where it underperforms the real rate of inflation, and you plan to keep it there for 2 more decades, it's like the risk is almost 100% that you're going to lose purchasing power and lose wealth. Okay, so and that's what most people are pushed into. And then we've done the podcast on it before. We explained it's like the reason why they're pushed into it is the person selling it to you probably believes that it's right because they've been confused into confused between the difference between risk and volatility. But the people who train those advisors know full well that if the banks themselves don't have a market for those bonds, they're insolvent. So they keep pushing those on their investors. So it's a really tough realization. It's that wealth is actually not getting transferred. People think that if you have one of the parents who has they're part of the top 20% and they got a net worth of $1.2 million or more, that you're going to get that, and those kids are going to be lucky and the rest are out of luck. It's like the harsh reality is most of those won't benefit that much for it because they're going to go through these inflationary tactics and lose a whole bunch of taxation. So and there's a whole bunch of strategies. Like most people are wound into these RSPs. It's like the goal is to wind yourself out. Okay, the goal isn't to be stuck with $1 million in RSPs at the end and lose half. Like that's just really poor tax planning, and that's really poor estate planning. But that's often what people come when we see estate tax returns come to us after someone passes away. It's like usually that's the nature of it, right? And then you just look at the currency deposits, like $1.6 trillion held of currency and deposits. It's like that is a certain loser. It's like, what is the optimal amount of cash to hold? Zero. The optimal amount of cash to hold is zero. Okay. You want to now that's not practical in everyone's situation because you got to have the right debt structure and the right flexibility with the credit products that you have. But basically, cash is a melting ice cube. If you're holding a percentage of your net worth in cash, it's like just times it by 9%. That's the inflation tax that you're paying every single year to hold that. Okay, so that's the part that most people don't realize because it's really hard for boomers to grasp this because at the beginning of their career, it's like they were taught at the beginning of their adult lives. Let's call it from 15 to 45, like their formative years where they're forming their opinions about the world. It's like it actually was structurally different. The system did reward people who worked hard and saved, and now it really rewards people who know strategically how to borrow money to invest. Like it's moved from the people who earn and save to the people who know how to borrow to invest. Like that's what it is. But that's a complete paradigm shift for the people who are hearing this for the first time. It's like they think they should bring their money to the bank, get a percentage of interest. Some of them are old enough to remember. It's like they got a 20% interest on a deposit in the 80s. It's like, well, that was a one-time event when they came off the gold standard in the 70s. It's like that worked its way through the system, and now we've seen what the effect has been for the last 30 years. And so it's really tough. The old, can you teach dogs, can you teach an old dog new tricks? It's like that's actually kind of what's required. And very few families will understand that and navigate through that, because there's a lot of emotions involved there, because what you were told was true and what actually was true 40, 50 years ago, it just simply has proven that it's changed in the last 30 years.
Yeah, I think there is a lot of fear that is involved with those decisions, right? So they make you fearful that volatility is bad, but really volatility is a good thing, especially if you're using dollar cost averaging into different funds, whether it's ETFs or stocks. If you DCA, it kind of mitigates some of that risk. It offloads it. Maybe explain a little bit about dollar cost averaging and the reason why you want to take that strategy going forward.
Yeah, like a lot of people are like, I don't want to buy an asset that has volatility. It's like, okay, you don't want to buy an asset that has volatility. That's a very good reason to not buy that asset all at once. But it's a very bad reason to put all of your money, or substantially most of your money, into something that will lose purchasing power over time. Ways to mitigate that risk is basically to buy small amounts over long periods of time, where that sometimes you're going to buy at a good valuation and you're going to buy at a bad valuation. And that's actually how you mitigate the risk, rather than put it into something that's not volatile, but 100% risk of losing purchasing power. And so and the other way that people just don't really wrap their heads around is managing volatility. It's like you don't have to avoid volatile assets to avoid volatility of your net worth. What you have to do is acquire assets that are not correlated to each other. So rather than acquire assets that underperform the real rate of inflation, you should have assets that are not correlated to each other. Owning stocks and owning real estate and owning gold and owning Bitcoin. It's like all of a sudden you start to get into these assets that are not correlated with each other. Most of the bank advisors won't even go down that, because they get a commission to sell the financial assets. They get a commission to sell the mutual funds. That's what they're getting a commission to do. They don't tell you, it's like, hey, you could have just bought an ounce of gold, paid a 6% fee, and kept that ounce of gold in your family for a couple of hundred years and never paid anyone again. So that's a realistic scenario, but it's a very bad business model for a lot of the banks. So they don't talk about that. There's a difference between volatility and risk. And there's ways to manage the volatility of assets without being forced into assets that underperform inflation.
Okay, so what is the solution? This show is about solutions. This show is about planning. This show is about educating. What do people do armed with this information, knowing that they're going to have underperforming investments in RSPs, CPP, pensions, and so forth? What are some strategies that people can use to kind of protect their wealth and shield it from as much government overreach as possible, or government theft?
I mean, it's important to understand the last part of the asset structure is real estate because it is the biggest part of the asset structure. It's $5.8 trillion. It's much bigger than any other one asset at all. So $5.8 trillion of Canadians, 11.7 trillion in net worth is in real estate. And so some of it's primary residences, and so far we don't have a principal residence a gain on principal residence tax so far. If I was, making Vegas odds, I would say, is that going to be the same way 30 years from now? It's like, no, I think at some level they're going to put in a principal residence tax that just says if your house is worth over X, it'll be subject to taxation. And that over X will seem very lofty when it comes out, and most people won't object to it at all. And then fast forward 10 or 20 years, they'll realize it's going to apply to them and everyone they know. So that's a likely scenario. So that people have these real estate gains too, and often people own more than one property. They have a rental property or two, and there's massive taxation on that, usually walking towards it, especially, they prudently depreciated the property. So it's not just capital gains tax. They have recapture tax that's taxed basically as other income. And so that would be a massive gain on death. And so they have to understand they're likely getting bled dry through inflation right now, and they're walking towards a major tax bill. And the solution, when you look at the various solutions out there, it's like we keep coming back to a family holding company. A family holding company really is the mechanism where you can start deploying assets efficiently, and you can work on an estate freeze that actually transfers the assets over time without tax to the next generation. It really is possible. So I'm not saying if you got $1 million locked in RSPs that you can unlock that and get away from tax. But what I am saying, someone who was starting out from the beginning, who knew the goal was not to defer income, but the goal was to actually build the family net worth, they can avoid that. But, everyone can use a family holding company once they're above a certain net worth to actually reduce their taxation, reduce their estate tax, even during their lifetime, and the ultimate estate tax after. So there are ways to pass those assets tax-free, especially those real estate assets. And people don't understand the commingling of those assets, owning different asset types is actually very important because they're all taxed different ways. And it's much easier for us to extract the net worth and actually pass that net worth throughout generations if they're not holding one type of asset. Okay. If they're if they just want to hold one type of asset, especially if it's an asset that's all capital appreciation, it's very, very difficult. I need an income stream from that asset, whether it's rental income or dividend income, to actually move that to the next generation. So that's the number one thing. People just need to up-level their financial information, their financial literacy, because there is a way to transfer wealth from generation one to the next generation tax-free in a way that really makes sure that generation one, they live, a really high quality of life, probably a higher quality of life than if they didn't exercise these strategies, because they're just making decisions out of fear and investing in products with a terrible rate of return. And they're dramatically underestimating how long they're going to live and how long they're going to get bled dry by inflation. And so they end up not living well because they're not, they live out those golden years in fear. And then ultimately they do get bled dry by inflation and pay a massive tax. So once people understand what can be done with a family holding company, what can be held in that family holding company, and how that's going to help the first generation live comfortably, and how it's going to help them minimize estate tax on death, it's that usually is the method that most people are going to adopt.
Awesome. I think that's very, very helpful for people out there. But I think another thing that folks should do, if you're curious about learning more, is attend our in-person boot camp. Next one is coming up May 11th. That's from 8 a.m. to 5 p.m. That's at West Edmonton Mall. And you can get your tickets at spurrell.ca, SPURRELL.ca. Click on the link. Now, before I sign off, do you have any parting wisdom for us, Josh?
That's it. I mean, the important part is like these come down to relationships. So it's not just the financial education; it's the relationships. And so people need to start early on this because the main things we can do for tax planning, they're available when people, have time on their side. When people walk into our office and they're in their 80s or 90s, it's like there's less we can do than when they walk into our office in their 50s, 60s, and 70s. So strengthening those relationships, having those money discussions now, because it's going to take a long time for people to get on the same page. So the sooner you start having discussions, the more likely that the family is to kind of get around the tax bed and beat them at their own game.
All right. Well, thanks a lot, Josh. Appreciate your time as always, and I know that the people who are watching this channel appreciate it as well. So, of course, if you need tax planning advice, if you need some help with your business, you can always reach out to spurrell.ca, fill out the intake form, and you can get a consult with Josh Spurrell and get a free copy of his book. So if that's something that interests you, definitely give him a call, and we'll see you guys on the next podcast. Thanks.